Once capital assets are capitalized and booked as assets, as opposed to immediately expensed, depreciation kicks in. What is depreciation? And why do we depreciate? Depreciation is expensing capital assets over a certain period. If a machinery with useful life of 5 years is purchased for $100,000, then the company may depreciate it over 5 years. For now, we assume credit side of balance sheet is retained earnings only in order to focus only on what is impacted by depreciation. In other words, bank loan or accounts payables are not impacted by depreciation. Depreciation over 5 years means expensing part of machinery over 5 years. Each time the machinery is depreciated, 1/5 of the total amount is expensed. So in year 1, 1/5 of $100,000, which is $20,000, is depreciated. PPE is reduced and depreciation expense is booked by the same amount. Effectively, $20,000 PPE has moved to expensed account. Debit depreciation, and credit PPE by the same amount. Debit books depreciation expense, and credit reduces PPE. PPE continues moving to expense, period by period until it becomes zero. We refer to the dollar amount of PPE as book value. The moment the company purchased the machinery, its book value is $100,000, and at the end of the first year the book value is $80,000, and so forth. Same thing in the year 2. $20,000 is depreciated and PPE further reduces to $60,000. At the end of year 3, the book value of PPE is $40,000. Depreciation continues and at the end of year 4, the book value of PPE becomes $20,000. Total amount of depreciation, or accumulated depreciation, is $80,000. Lastly, at the end of the 5th year, the PPE is fully depreciated. No more depreciation in the subsequent years. Another important point to understand about depreciation is the cash flow over the life of assets. All of the cash flow, or CapEx cash outflow, happens at the very beginning when the company spends CapEx and acquires PPE. And this is it. Just because we have depreciation expenses booked in the income statement every year, does not mean we have cash outflow. Again, the only cash flow is initial investment cash outflow of $100,000. Finally, let's look at why we depreciate. CapEx is an investment of assets which is to be used over multiple years. If we expense all of CapEx when spent, the income of the year is significantly understated, whereas the incomes of other periods within the life of the asset are overstated. It is unreasonable for one period, in this case is the period CapEx is spent, to bear all of the expenses. Because subsequent periods also enjoy the benefit of the investment, those periods also should bear their share of depreciation expense. The philosophy is for each period enjoying the investment benefit to also bear their fair share of expense, and depreciation is the methodology to allocate such expenses over the periods. This is called the matching principle, where revenue and its necessary expenses are supposed to be booked in the same period.